Good afternoon, everyone. This is Chrissy from Solstice ATR, and I just want to wish Happy Mother's Day for all tomorrow, Sunday. Enjoy your day. And let's first get started by you can find me on Solstice ATR, Twitter, Instagram, as well as Discord. If you have any questions, just do ask. You can hit the subscribe button on YouTube. It's actually free, the weekly video on the overall market. And let's first remember, this is for illustration use only. We're not a broker-dealer. Past performance doesn't indicate future results. Use at your own risk, and data may not be copied unless you ask for permission. Let's just flip one more page over. And I wanted to talk about the markets and signs regarding, is it going to be more riskier outlook in the market for another leg higher or a leg lower in case the Federal Reserve does change their policy and inflation is around the corner. We always have to have a plan for a bullish and bearish scenario on the short term as well as the long term, and don't be biased to one side until things do change in the trend. And this is why I have the combination of those four instruments, the three instruments here, the S&P, the NASDAQ, and the Dow. And I put a sign here saying the exit. So there's always consolidation, a breakdown, and a small reset, consolidation, breakout, and another reset, a consolidation, then a breakout, and a bigger reset. And eventually we are starting to get away from the 50 simple moving average. At the same time, as you can see, we ran away so far away from this. This is the February, basically pull back down because the ADX RSI got too high in the momentum indicator. We pulled back to where the RSI and the momentum indicator in March 23rd got to the low, and eventually we reversed and continued higher. We had the September highs, then November highs of last year, because of the COVID release, and we had the January low in March. I'll go into them in detail, but this is the reason why I have this chart up there. Remember, for every pullback, you usually get a larger pullback. I am not bearish. We're not biased to either side. We trade what's given to us in the future on the charts, not what we think, and we use historical numbers just to overlook at the overall markets. One more chart, and here you can slow down your video. This is why I said, that we have to take a look in overall market if there's going to be another leg higher or bearish. We get bearish when it presents itself in the charts and the data in front of us. And this is when we are, in case in retirement account, we do not know how to hedge. Some people don't. They trade only to the long side. So they have to, take some of their position out, put money in the cash in order to buy a lower position. And here's the reasons why. Market expectation, investor sentiment, it's about 50%, 50-50, bullish and bearish. On Friday, it was 52 to 48%. National financial condition on the indexes, credit spread between bonds, inflation, copper, and gold. Studies do help us to prepare technically, strategically to do a plan. Don't have a biased opinion. Be maximum flexible. Don't assume things can change. Don't listen to the news in the market. Trade what's given to you. And we'll go over this a little bit later in detail, the breakdown of the total returns. Let's first look at the combination of the three. We can see here that we pushed a little higher and we continued. This is the chart I put on the beginning of the charts. Let's go here and take a look at where is the Dow in relationship to the Russell, the NASDAQ, and the S&P, because things do shift from one instrument to another. This shows you the weekly overall, the sentiment still bullish. The volume was 826,000 by end the week as of yesterday, as of Friday's May 7th, volume on the weekly. So if I go here from the weekly to a daily chart, we're going to change the time frame. So we're going to go a little shorter. Instead of 1 year or 5 years, we're going to go 6 months. We're going to go to a daily chart. and we're going to push OK. The reason why I put this up, this was the annual high in December 31st. We pushed up, came back in February, January 1st, did a slow. And in February, the low in the Dow was a little bit lower than in January. Then in March, this was the low. Then we continued higher after the vaccinations and everything started to come back up. We have the monthly fib and the weekly fib. What we usually do on the monthly, we look at April 1st till April 31st, where the highs and low. We have the extensions to the upside, extensions to the downside. We rounded ourselves back up. We got a nicely inverses hammer in the last 2 days. The Dow has been climbing a little bit more quicker than the S&P as well as the NASDAQ and the Russell. This is the Dow. And you can see it says long bullish. The sentiment on the short term, up, midterm, and long term. And this is our volume yesterday on the daily bar. Let's take a look at the ES, which is the E-mini contract for the Fortune 500 company. This is our annual high in December. We had the February pullback. The January 4th was down here. That was the low for the year. This is the March low. We recovered. This was the push higher, look back in, push higher, tested the prior high, fell back down halfway through the consolidation and the prior breakout in January 22nd. Then we continued higher. We had a small little reset the last 5 days, 3 days down, and eventually the last two pushed higher. We have an annual high for the year. We have the monthly Fibonacci's. We are in an up channel. As you can see, we are in a linear regression channel. As long as we are above that, we tested the 18. But the 50 SMA and the F3, which is a 38.2, we are far away from it. This is our monthly fib for April, high and low. Our midpoint is here, and our 61 is around 4,066. At the same time, our weekly fib is here. We know where the retracement of 161 and 261 is. And if we continue higher, we'll have the Fibonacci's to the upside where the 23, 38, and 61, similar to the 161 up here. And this will meet with the monthly 38.2 fib. On the S&P 500, if I compress it a little lower, we can see the 38% and the monthly fib, they match very nicely on the charts, on the monthly charts of the S&P 500. So let's take a look at now the RTY, then I'll come back to the NASDAQ small cap. As you can see in the RTY, we can see that we've been consolidating for the last month and a half. We have April, it's inside the March range as well as the February. If I zoom in here, we are consolidating. We are in a linear regression, smaller channel. We tested the backside of it and eventually U-turned, and we came above the 50 on the daily, the 18, and the 5-day moving average. In order to run, we have to clear the 2285 area, 2290 in order to continue higher and go up to the monthly prior high. Or if we fall through this channel, we look at the 38, 50, 61, and eventually the 161, which is the Fibonacci, and the 116 simple moving average, and the prior consolidation at 2164. Let's take a look at now the NQ. Since the market was rotation, they went to other sectors. We can see we had the April move was up. We looked a little bit higher, but eventually out of this month in May, we fell a couple of days down. Then we eventually, on the weekly chart, we recovered 50% of that move down from Monday, Tuesday, Wednesday, Thursday, Friday. We retested that. We touched the 18 SMA and the 61.8 on the weekly fib high and low. We have to clear this area in order to continue higher. If we don't clear the 61.8 fib, which is the 13,825, to continue higher, look for the backside of the 38 and eventually downside of the 50 simple moving average to hold in order to continue higher. If there's going to be sector rotation and they go back in large cap, tech sector, and healthcare, then we can continue higher, no bias to one side, trade what the charts give you, and that's why you don't, end up to be on the wrong side of the market. Let's take a look at GC. And the reason behind GC, we have been in a linear regression down channel as of last year, but we are starting to nickel our way back up, trying to retest this area here of the consolidation. If you drew a channel in the middle between this one and this one, this was the prior consolidation. We have to break out of this area in this channel in order to get to the 1893 and eventually to the 1945 area where the breakdown was from the prior January high that we had on the 4th, and eventually we fell back down all the way down to the 1670, 80 area. We double bottomed, and eventually we created a small W. We consolidated it, pushed up, fell back into that range of that W, and eventually, finally, we broke these candles that we fell from. We're trying now to retest this consolidation. We have to break this area in order to get to the January high. And I think the sentiment, if things are in inflation starting to come up, gold is going to be the safe haven to continue higher. And this is the reason why I put this Fibonacci on the monthly fib. You can see the April high and low. We eventually broke out of this 1800. We got to keep an eye on 1810, 1808 as our line in the sand. If we fall below that area, you have to be careful of it. And if we're going to continue higher, we are looking to, to eventually break out of this channel. We broke out of this symmetrical triangle. We had a smaller one here. This is no longer valid. We have to take that channel out of the way. Remove it. Remove drawing. We had this one here, but I kept this one here because of the consolidation. I can keep that one up here, and we can keep an eye on the 1824, which would be more reasonable channel than this one up here. So we're going to remove this one out because we retested it and failed from it. What I can do is grab a channel here. We'll do this together. While we're doing this video, we put the line here. We connect it to the prior high. We're going to keep this channel and this channel intact, which is no, I'm going to go a little closer than this. I'm going to take the other one at the bottom, remove drawing. So we have the linear regression channels are parallel to each other. We connect them here. We know these two are parallel. In case we do come back, we have a midpoint right here. It's around the 1810, 1812 area. We do not want to see 1808 lost. We can fall back into the prior range. So trade what we see in gold. Let's take a look at CL. This is crude oil. Crude oil, in March it had an annual high, then fell back in. We consolidated in range bound, and in April we tried to break up. We looked at the 65 area. In the last 3 days we consolidated, fell back in the range. We have to keep an eye on the 38.2 fib, which is the 62 or the 63 area, in order to continue higher in oil. And oil had a nice reversal hammer, but was not able to close in the prior day range. We have to keep an eye if we can get back and close above this candle to continue higher, or we come back to the backside of the channel in the 18 SMA in crude oil. Let's take a look at BTC, Bitcoin. Bitcoin, as you can see, we had filled the prior gaps here. I left those GAPs there because to show where the gaps are. Once we fill them, I take the cloud out, but I keep the word gap so that way you can see there's still two gaps down the bottom, which are professional. These happened in the overnight range. We are trying to get out of a symmetrical triangle. We came down. This is a small symmetrical triangle in the down channel, and I believe BTC has not found its momentum to go back a little bit more high. We're going to remove this channel. We're going to connect this candle here that we have on the weekly with this one here. We are in an open cone. We do have an up channel here. As you can see, you can connect this candle with this one to make sure we are in a symmetrical triangle in case the breakout or the breakdown in BTC goes to the upside. We look for the 61.8 and eventually the monthly high. Or if we fall through this channel, we look for the backside of the 23 and eventually the 100% of the down channel here. I am not biased on either side because Bitcoin has been range bound. If you look at the prior highs here at the 57, 58,000, we've been range bound in this area until we get out of this consolidation So trade what the charts are giving you, not what you think. And this was the prior, breakdown on the gap down. When we fell down, we have filled a portion of this gap. We have not filled 100% of it. If I'm going to adjust these channels a little bit more, we remove this channel. If I'm going to adjust this gap, I would go to this high here to show where the gap has not filled. We're going to extend the edit property. We're going to extend it all the way across a couple more days. We're going to go from 4:30 to go to May, let's say 10th, or to 14. We'll go to 14. What is the high on this candle? We would know that the high is on it 59,305. 59,305. So you can see where the gap has not filled 100% of the move. And this is part of the reason why you still have that portion in the gap in the profile. So if I zoom in a little bit more, you can see where the gap is in the prior. These are the overnights. This is the professional gap. We fell down. We created a diamond shape. We are in a symmetrical triangle. Once again, we have to clear this gap in order to continue higher. If we fall through the channel, we look for the other side of the fence in BTC. Everybody's talking about ETH, Ethereum. I'll just go over it a little quickly. Ethereum has broken out. It has an annual high of 3,600. The most important thing, it created a couple of dojis up here. Usually when you create dojis and cannot push any further up, you may get consolidation for a small relief before continuation. I am not biased to being bearish or bullish. You have to trade what's given to you because you had a professional gap on Monday, continuation Tuesday, Wednesday, Thursday was a look above, come back inside the range, and on Friday, you looked into the range of the Wednesday candle and you broke up and closed in the Thursday's range upper distribution from the prior close on the candle. So in order to continue, it has to break up. If it doesn't, you look for the backside of the 61 and this channel where it broke out at first before you try to attempt going back into the long. So try to trade momentum, not what you think. Let's take a look at now TLT, which is the ETF fund for the bond market. We do have, you can see, this is the 20-year treasury. I usually use the IEF. We have this professional gap. We have this gap here, because interest rates have been, starting to climb, but they're saying you have to be careful of what's the Federal Reserve policy is, as well as in the White House, you have Janet Yellen speaking. It's creating a little bit of tension in case there is a change in the currency in the dollar, the inflation, and the bond market. This is why I'm showing the 20-year note. If I go TBT, that's the inverse relationship to the bond, you can see that when interest rates go up, the par value drops on the TLT, the TBT ends up to be the inverse relationship to that bond. If I look at the IEF short-term 7 to 10-year notes, we can see where I have put the gaps here. And eventually we're starting to fill those gaps. We're getting a rounded bottom. If interest rates stay low, you have to keep an eye on the banking sector, which is the XLF, and the reason behind it. And you have the monthly fib here. We are in consolidation trying to break about that symmetrical triangle in the charts. If I look at the XLF, which is the banking sector, you can see that the banking sector, because if they increase interest rates, the bank make more money in credit card companies. You have to keep an eye on that in case there's a relief or there's a change in interest rates, XLF. If I look at the SCH, I believe X, that's the same thing as the XLE in the banking sector, and this is the Schwab Large Cap Strategic Trust. So this is the reason why I'm kind of going over a couple of ETFs. So you guys, if you cannot trade futures, you can trade those ETFs. And the SPY is the ETF fund for the S&P 500 or the E-mini contract /ES or $ES, underscore M1, H1, whatever the contract is at the companies that you trade with, or the SPX is the large contract for the Fortune 500 companies. This is a mirror image of the SPY. So last but not least, what I want to do, a couple of equities, so we have to be an open mind to change in case things do change. Let's take a look at AAPL. This is Apple. It came back in consolidation after the earning and the dividend. If Apple gonna has to clear the 35 area, 34 in order to run. It's still under compression. It's in a symmetrical linear regression channel. I don't have these channels drawn. You can connect this line here with this one here. You can see where the major channel is. And if I connect this one to this one here, that's our main line in an up linear regression. If it falls through that and loses the 50, you look for the backside of the 61 and the prior consolidation in Apple. Amazon. You can see Amazon fell back in after earning. It's consolidating. Keep an eye on the reset where the simple moving average, the 5 and the 18 cross, continued higher. If we retest the 50 SMA and the 200 116, you can see the 161 or the 61.8 fib extension. Let's take a look at Google. And you can see Google has consolidated, did well. It's still in the upper range. It retested the gap. On Friday, it had a gap up. In order to continue, we have to clear 23.85 to run higher. Let's take a look at the NFLX. After the earning, it fell down like Amazon. It's been in consolidation in this island. In order for Netflix to clear, it has to clear the 525 in order to run up to fill the gap. And if it cannot fill the gap, we look for the backside of the Fibonacci extension, which is the 475. Let's take a look at Tesla. I think General Motors is going to be doing much better in the next with Ford. And they have a good structure. We are in a symmetrical triangle in a down channel in Tesla. On the weekly charts, it does not look for me a great setup because it has lost a couple of its levels. I'm going to restructure this channel here, remove the drawing. We're going to connect these two dots here, or this last one here. It's in a symmetrical triangle in a down channel, and I have a linear regression down channel on it. If I zoom in after, because it has reported, it fell back in. You can see it's in the symmetrical triangle. It's below the monthly fib extension. It's just coming to the zero line. Retested it, bounced up, and on the weekly still down. In order to run, Tesla has to clear 708, 715 in order to run up. If it falls through the 650, be careful of it because you can retest the backside of the 618, 620, and then eventually the 585, 595 area in Tesla. Let's take a look at BA, Boeing. Similar situation, is still in a downtrend. It's trying to reverse. Keep an eye on Boeing. There may be a possibility of a reversal in the defense system. Lockheed Martin, LMT. You can see Lockheed Martin has recovered quite a bit after the earning 100% of its channel. If it even retests backside of the 380, 385, it may go back higher. And let's go back and take a look at the SHOP, SHOP. SHOP, you can see, fell back down. PYPL did well. After the earning report, fell back in. They didn't like the numbers, so it's in the consolidation range. Take a look at Zoom. After the reopening, Zoom, from the prior high, 485, has finally fallen down to the 295. Everybody was thinking, everything goes up and must stay up. Eventually, what goes up comes back in and resets and finds a level before continuing higher. CMG, Chipotle Grill, when it was in the 280, we used to think it was expensive. It's in the 1400. Is CMG still good? It's a good company. It's the most expensive burrito in the world. That's how I look at it. And it's still consolidating right here. To see if it's going to clear, you have to keep an eye on the consolidation and clear the 38, 50, 61 to run. If you fall through this consolidation down here in this gap, I think the reset should be back to this area here in the 1250, 1260 area. So let's go back to the ES mini contract. And what I want to do here in the ES, I'm going to break it down on the 4 hour on a faster time frame to show you the levels and the reasons behind, not the madness. We trade what we see in the on the computer and what's given to us in momentum indicators, supply and demand. I try to keep this as simple as possible. This was, the April low to the April high. We consolidated, fell back in. We created a small W, and we eventually broke out of this on the monthly chart. My 42.10 area, as well as 42.05, 42.03. If it is lost, I would look for the backside of the channel in the breakout, because this is a symmetrical triangle that we broke out. If I take the distance from here to here, we can still travel the same distance from here to here. But if the reset comes back, you look for the halfway, has to hold in order to continue higher. And the 41.92 is very important area. 41.88, if it is lost, I think the reset would be around the 41.65 in this big consolidation area here. And the major one would be down here on the 200 SMA, which is the 4100, 4120, in order to continue higher. But if we continue higher, that's great. If we change direction, we'll lose the 42.10, 42.03 area. Then you look for the 41.92 to hold. If it doesn't hold, be careful of it, because it can turn the other direction on the S&P 500. Hope you enjoyed this video. Before I do say goodbye to you, I want to go over those 3 slides that we have in the computer before I let you guys go. We're going to minimize this. We're going to maximize this chart here. And we went over this earlier. Just, take a snapshot of it, review it, understand it, and if you have questions, more than happy to help you. Here's the 3 scenarios I have in the S&P 500. I didn't talk about it that much, but I want to talk about it on the slide. These are the 3 scenarios where the RSI, the momentum indicator, and the stochastic got a little bit extended. This happened, in September of 2004 when we had the reset. This is case 1. 2009, 2010. This happened in July when we got the reset. Is the same thing in 2020, 2021. May 7th of 2021. We're still in an up linear regression channel like all of them. Eventually, if we're going to fall, here we are using the SPX and the SPY. I'm just going to zoom in so that way you are seeing what we're showing you. The William R is similar to an RSI momentum indicator. It's showing you where the expansion and contraction of the SPX or the SPY is in relationship to the TLT. In order to change the right direction, we have to be open mind to change, whether it happens on a daily basis, a weekly basis, and the trend does turn. We have to exit and think the opposite way in the charts. And this is the reason why I showed this chart here. And let's go least but not, where is it? Why is it doing this? Okay. Here's the scenario where we are in relationship to the SPX or the ES. I have the September highs. We had the COVID release. We had the January low. I went over them in that chart earlier at the beginning. And this is the March low. We had 71% of the cases where the NASDAQ AD in the breath, the individual investor sentiment that happened, when these cases were there. We had these drawdowns and draw ups compared in relationship where most of the range was. 71% of it was in the upper distribution here, and the 20% was in the lower distribution here. Can we get a 15% drawdown? Yes. Can we have a 5% drawdown? Yes. Can we continue higher? Yes. But we have to take a look at the maximum flexibility as a trader, the outlook for 1 month, 2 month, 5 months, 6 month, 12 month, 18 month, 15 month, in relationship to the short-term noise in the market in order to continue. And this is looking at it historically. These are only assumptions and hypotheticals as of May, in case things do turn to the upside or turn to the downside. And this is where the maximum drawdowns are in relationship to the charts, where you can see the drawdown is as low as 34.82, and the highs, average hypothetical high, is around the 40 179. So we do not want to be bearish or bullish until things change and the sentiment change in the market and the unemployment rate. There was a little on Friday, unemployment rate came in a little bit under, and it caused a little reaction. If the Federal Reserve Board and the economy is still going to be on track, the government has to do something. If not, and inflation comes around, things do turn around and people don't want to go back to their jobs. That's totally different. And this is the scenarios where in relationship to where the draw ups to the drawdowns are. And even if I take that minus 4 5% and I split this, this has about 51% to 20% down here in relationship. You say, you take 20% of it, that 4% down withdrawal, then you can split it into three groups. What I did, I just split it in two. And the reason behind the zero rate of change compared to a minus 15% drop down. And I hope this was helpful to show you the levels. You can look at on Twitter, Ned Davis Research at NDR_research. I usually used to use them a lot with a couple of other Dun & Bradstreet and Morningstar for my research. And the reason behind it, in case we get a push higher or a push lower as of May, medium range for high and low, and the expectation, 1 year drawdown to 2 year push higher, 3 year, 4 year outlook in relationship to the numbers we had on Friday, where the market closed at 42.3260. And I hope this was helpful. You enjoyed the video. Have a good Mother's Day tomorrow with your family and loved one and your mom. Take care, and I'll see you on Discord or Twitter. Over and